Hi, good
Hi, good
evening,
evening,
everyone.
everyone.
I'm
I'm
audible.
audible.
Okay, so let's. What's going on? Stop. Something. Okay, I think everything is going well. Just quickly, my screen is visible. I'm audible. So, but now one thing is interesting. Hello.
Hello, hello, hello.
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 Hello, hello, hello.
What's wrong? Hello.
No, no, no.
Can say talking live. Would you please join from
Join
the
from the.
YouTube? Same thing. Stop. This is creating problem. Hello.
No,
I'm just
I'm just
leaving the
leaving the
meeting and
meeting and
I'll
I'll
join
join
again for
again
the
for
Zoom.
this.
Hello. 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 Okay, so let's. this is will lose some time. I'm audible? Yeah, now I think it's fine. Yes, Amir is there. So, Amir, would you please quickly confirm if I'm audible? And please confirm you joined from the YouTube also, or only from the here. Yes, Amir. Okay, so the Amir is saying yes, yeah, I'm audible. Okay, everything is going well, so let's continue with that. Okay, so let's see the quickly the today we have with us Priyanka with us, Abdullah is with us, Amir with us, Prabhu is with us. Okay. First of all, thank you very much for all of you guys for your dedication and managing to come for this online session for the corporate training is not easy after 8 hours, 9 hours the day activity. Then you're managing to come online, taking this additional, even if you're beneficial, but still is you are doing the effort and hope you will get the reward for that. So let's dive into that. Unmute upon entry. Okay, mute upon entry. So then, give it a second. We are come to. Yes, you may join from the YouTube link also. I appreciate that. Subscribe the YouTube, and you may join because moving forward, maybe we are coming on YouTube live only. Anyhow, let's dive into today's session. Before starting today's session, so I'm just starting this recording for the housekeeping stuff. Good evening, everyone. Ghazanfar Hussain with you from PTT Consultant. Today, our session number 9, May 21, 2026, part number 23. So in each session, we have multiple part where we are trying to making part by part on session on topic wise. That same we are uploading on the YouTube where you can easily go and search and take the revision if you're required to have the some uh, if you miss the session or if you want to revise that particular topic instead of going for the complete 2 hours 3 hours video. So today our topic is the uh, election. Under election, so we have the realized unrealized gain and losses. Unrealized gain and losses. Again, the election we discussed in the previous ethic journal, but today the complete topic we're gonna allocate to this topic and where we're gonna do the practical couple of examples to and cases and scenarios where we will learn how this analyzation case gain and losses will be applicable in the UE corporate tax return filing. So We are particular on this topic today, and if any question from this session are be- belongs to this topic, so most welcome. So session number 9, day number 9, today is May 21, part number 23. Then again, now we are continuously discussing the UE corporate tax, and we will focus on what is the taxable income. Now we said, okay, the competition. So the computation of the taxable income. So while diving into the computation, we've seen all the steps, how to calculate, what are the element. So now one by one, we are diving into that and trying to understand how the each topic or the each element in Corporatex return filing is affecting us or requiring the data or the working from us. From where we can get this working, if we can get this working from the normally, I'm going to use the audited financial statement or in-house financial statement, or we can say the accounting system. So all of them will be relevant. All the way accounting system will be relevant. So here is important the accounting system. Any accounting system who's give us the good accounting report, then I'm going to use the word the financial statement because our working will be starting from financial statement. Then of course all the information may be not easily available, then we have to move back to the accounting system where we need the accounting team support. Why the accounting team? Because they understand much better than anybody else their accounting system, because they are doing the day-to-day transaction. So here this is we already seen the fifth adjustment out of eight adjustment unrealized gain and losses as per ministerial decision 134. So it may looks like a repetition, but it's not the repetition. We are diving into that. So if the election is made, so the election made, so then we have to see the realization basis we opt, or we have opted for the uh, other way around on realization basis. So if realization basis is we opted, so what we have to do, realization basis is opted. So we already knows that in accounting profit, accounting profit, we already added this figure. We already added this figure. So I'm gonna take the example, the any accounting figure. So because in normal accounting practice, what we are doing, if we did the uh, at the year end, any adjustment, so we revalued any a particular item, revalued any particular item, so the effect will be already over here, is added over here. So maybe it's a 1000, so it is 500, so which means this is already, so this is the as per accounting, because accounting is doing as per IFRS. So here particularly we are saying if we offer the if we made election first thing, then we said we offer the realization basis, then the gain, if this is the, let's say, is the gain, but this gain as a result of the revaluation, as a result of revaluation, so as a unsold revaluation, as a unsold. The word unsold is very important because we have the gain, but as a result of revaluation is unsold. So that's why we're saying we have, what we have to do, we have to less this 500 that we already added over there, right? So this is the adjustment we're gonna make. This is the in case of gain we are seeing. Why? because we said we will pay tax when actually sold. Realization basis actually sold, but here is not actually sold. The same scenario, if lost, it will be hit oppositely. I'm not going to spend the time more here. We will jump into the relevant particular examples. Okay, this also we seen the analyzation basis if like election is made. Okay, so we already seen that how the looks like the election. This will be the election, and this we have to opt for the here realization basis. He's saying we will opt for the realization basis or the unrealization basis. So we have to choose accordingly. I appreciate the participant, even you are continuing from the Zoom, but if you join from the YouTube also, that will be appreciated, all the participant. You may continue, maybe mute that and continue from here. Either way, available for you, but appreciate if you can join from the YouTube link also. Thank you for your support in this regard. Now, is the taxable person or insurance person? Then, very next question when we say yes, we want to do. Why they think the bank and insurance? Okay, because certain thing is not limiting these industries. Okay, the interest capping rule, one of the example is not applicable on that. Okay. So mostly we are talking about no in returns. We are not talking about any bank and the insurance companies because their treatment is may differ. If, because their treatment may differ. Now we already seen in the previous session where we said okay, we elect fertilization basis. Now we said all asset are the asset held on capital. So this is the we already seen in the previous session. We already seen in the previous session the same. So if we seen the realization basis, then we have to make the adjustment. This is one of the small screenshots. So now this is the corporate tax return filing. If the first part, what is the first part? Before that, uh, the taxpayer detail. Okay. So this is the nobody is saying correct. Okay, if trade license everything is good. So this is the on portal is look like the return. Portal is look like on the return in this fashion. So then we have to go over here, click over here, and continue with the return. On the return, the first part is the taxpayer detail by default is already updated. If you want to change, we can change over there. Then here is the 8 steps of the corporate tax return filing. This is the same screenshot we taken from the FTA portal, and we extract the relevant. Okay, so now the second step will be the election that we are discussing today. The election is today is here. Okay, so when we talk about the election, so the one of the election is coming with us the realization basis that we have to opt or not opt. We have to take the decision. So we are here on the election, and under election, here is the same. See, such things we are making the same screenshot. Okay, if we say the no. Uh, Excel person don't want to opt for the election realization basis, we will say no is good, no further implication in the return. Everything whatever in the accounting system same will in accounting system are the accounting system are the audited financial statement. The word may be the accounted figure, it will be continue in the same basis. Okay, Why? Because mostly we are paying on accrual basis, but preparing our accrual basis. Our financial statement we are talking about on accrual basis. If we have the cash basis, then the picture will be changed. Okay, so this we are talking about on accrual basis accounting as per IFRS. So if no, then how the figures, because normally is coming on the unrealized basis in our accounting. So we'll continue the same. Even the revenue and non-current asset, the capital account asset, same will be continue. The second option, this is the first option we said no. The second option here we are saying, actually this is if we opt for yes. Okay, here of course we will say no. So the first option is all asset. Okay, this is how is this is the how, and then this is the B option. Just keep this slide is very important for your understanding also, because it's not easy to understand the realization basis and unrealization basis. You may take the screenshot and something like that, keep it with you. Although we sent previously in the group also. Anyhow, so this first part is finished. If no, no more activity, no more activity, or no more impact in the return, no more activity. Activity means in return, city return, or we can say no more adjustment. And this is the easy for the accounting team. They don't have to do the rework to calculate such things. To calculate such things. But on other side, if we have to focus on this, because again we discussed in previous session very detailed, we have to see what is the right for the organization, what is the right for the organization, what is the right for the company. LLC company is what is the good for them, what is the best suitable or best fit, how the best fit as per the business nature or the operation. This is the how we take the understanding. We took the example, we discussed the example in previous session, the cricket match. Okay, so we said the if let's say India versus Pakistan. So then when and we said the normally, I'm not giving any, but it's just common thought. I'm not saying. Just keep for understanding. Don't take this my opinion or something dominant on any of that. Let's say the Indian cricket team, they have the best batting. Okay, so if they won the toss, so they will say we might go for the we might go for the batting first or might go for the bowling first. How they will decide based on the pitch condition, weather condition. Okay, so these are the factors. Then we said this batting strength. They will consider all these factors, right? So pitch will be the common, but weather will be the common. This is the another third point. If we are looking from that side, if we are saying one point is here, second is here, and third is here. Now, when the other way around, if the toss is won by the Pakistan, so what they will see, they will consider as a strong point is the bowling. This is their force point. So now, so India is considering the third point is a bowling as the judgment. So Pakistan is again considering 1 plus 2 plus 4. But here India is considering 1 plus 2 plus 3. So first two is common, and third and fourth is a different. So again, what I'm trying to explain, this depends upon the business nature, operation, and see the next is the, now they will say, okay, business nature will be common, same like I said the pitch is a common. Okay, let's say here, then I said the weather condition, then I'm saying the operation nature. Then the third what will be? Third will be the, they might be their priority is a cash flow. Cash flow. So what is the advantage of all this exercise is cash flow. Why we are going to take this election is the cash flow. So this is will be the third point. There we are saying the 3 or 4. So here 3 and 4 is common. What we are saying the cash flow. The business of course wish to see, okay, what is the cash flow. And this election is giving us deferral relief, is not permanent relief. Another important concept, this is the deferral relief. Okay, cash flow means based on this election you may not pay tax today, but in future when the actual transaction or actual event is happen, or that you sold that assets or the item, so you may pay tax on that. Okay, so this is the what we are learning over here, deferral relief. Deferral relief, ultimate we are paying the tax, but on we don't want to pay now, so that's why we're not paying now, so we save our cash today. Cash out is safe today, right? If cash out is safe today, so which means we can use for our business operation. So normally it have the huge impact where this and the any other strength, we can say the accounting system also. So this is the multiple factors where is affecting. So any question so far, please let me know before moving to the next. So any question so far is most welcome. I appreciate if you have any question. Any. Okay, no question. So let's continue the same. So this part we covered so far. So now this is the same thing. Normally, this is considering as part of the impact assessment for the each organization. This is the important they have to understand. But in the previous slide, I forget that. So where is gonna impact unrealized gain and losses? Okay, and gain and losses. So the we are saying the fair value or impairment is it will be having the impact, fair value and impairment accounting. Okay, non-taxable and non-deductible. Capital item non-deductible, non-taxable. Revenue item taxable and deductible. So this is the unrealized gain having the impact on that area also. So the I'm not spending the more time on this. Let's dive into the. We will see the quickly the election. The first we are saying we don't want to use the realization basis. That's good. Where we are election, then we said the realization basis, then we said no realization basis. So there will be no further implication. Okay, in case of no, this will be again irrevocable. The irrevocable is very important for our learning. Irrevocable is what, then if see these are the either way, If we can go for the no, then no further field will be, no further boxes, no further boxes will be open. So this is the one of the. Now the next way is saying the person would like to use in case we opt for the yes. So what will happen? Then again, this is also irrevocable. Keep in mind. So irrevocable lifetime. Then the next question is coming: is it excellent bank and insurance? So focus on that. We are not bank and insurance. So so normally we will say the no because if we are not the bank and insurance. By mistake, I think we opted for the yes, but now here we're gonna say the no because the bank insurance have a different implication. We are discussing the this part only. So that's why this is again the same slide. When we said no, okay. See if just see if we say the here if we saying the yes, okay. Just focus over here. No further field will be available. The further all asset and all liabilities is capital account is not opening after that. Why? Because the treatment for these industries are different. Why? Because as I mentioned, the nature of business transaction or operation. So normally, if we come in the uh, banking sector, so the banking sector, what is their business? What is their business? The funds they have belongs to their customers. Funds belongs to the customers. If the funds belongs to the customers, so the we will say okay, realization on realization basis, realization basis will be there. So they have only one option, that is the capital. They don't have all asset option. So that's why they did not give the option. So there for banking or only capital account option is there. Capital account if they have the fixed asset, some kind of the fixed asset, so that may applicable because rest all on revenue they don't have this option. Okay, what does it mean? They can consider this realization based on capital account. Capital account, what we are saying, the fixed asset. They don't have the option of current asset. So that's why they didn't open the next field. So now if we're saying the bank and election, okay, we are saying that again, yes, realization basis, but we are saying we are not the bank and insurance provider. If we opt for the no, see, this is the important. If this election is selected or opted by mistake wrongly, the treatment will be changed. I have the discussion recently. One of the uh, uh, the person who was from real estate industry. We are discussing. He's saying, okay, unincorporated partnership. The point was unincorporated partnership. So he's saying I checked all the fields of the city written from A to Z, from A to Z. So there is a no option coming if where I have to add the accounting or the figures if you are saying come from the unincorporated partnership. So I didn't found anything. Why? Because he's not familiar properly with this. So he's saying they did not give him how to add over there because if you not selected this, the below field is not pop up. The below field is not gonna available. First we have to select this, then this field added into the field. So same thing if we offer the banking, and then the below field will not be available. Yes, Abdullah, please unmute yourself. Unmute yourself.
Assalamu alaikum, sir.
Welcome, Sam, please.
Sir, I have a question. Like you said, the realization basis is irrevocable.
Yeah.
So all the elections are irrevocable,
Sorry,
or only this?
come again. All the election.
Like you said, the realization basis election is irrevocable.
Yeah.
We cannot go back.
Yeah.
So all the election, it may like all the elections are irrevocable.
Okay. See, Abdullah, here the most of the election is irrevocable, and the three election is revocable. All election are irrevocable. Irrevocable lifetime. Whatever you selected is there. Until unless there is another scenario under particular situation may depend. Okay, but normally these are irrevocable. Now the question is, all election is irrevocable. See, the small business relief, SBR. Okay, so if your revenue is less than 3 million in 2024, you can opt for this. In 2025, you not opted for this, but still the condition is less than 3 million, you not opted. Okay, so now this is the revocable, right? Here is you opted, here is not, so here
Understood.
revocable.
Yes, sir,
so
understood.
so this is the one.
Like this, if we continue this, sir, for example, if a free zone company
I'm coming on that.
before in the first filing period
Yeah.
selected normal under the normal corporate tax regime, like they do not opt the 0% corporate tax assessment.
Yeah.
So in future, can they elect for the 0% corporate tax?
Yeah, this is the our second point. See, the is a good point, qualifying free zone person. See, this election, if the first year, let's take the example of 2024, they opted for the 9%. I'm saying that they opted for the 9%. Okay, so then this year and following 4 year, it will be irrevocable. Revocable. After that, after total how many? Current plus following 4, total 5 years. On sixth year, it will be open this election. Open election means they will open this box to choose again to go for the 9% or 0%. Okay. So, but here is the 5 years, 1 plus 5 year, you cannot change this. This is the limited time irrevocable, and this is the lifetime irrevocable, right? So
Yes, clear, sir. Thank you so
okay,
much.
there is one more area, sorry, one more election that also may be revocable, but depend. Okay, but particularly this the first three election, what we are choosing, the one of that is this one. This is a lifetime. So this is the FTA is saying, not we are saying. Even now, if you opted in the first, why? Because your whole accounting depends upon that. Your whole treatment depend upon that. But now in 2025, there is another Abdullah. Now you triggered such question. Is nice question, but is leading to some other discussion. Anyhow, the discussion, if now before we know no depreciation in the UAE, no depreciation as in UAE city law. Okay, but now in 2025 they given on the investment property 4% depreciation we can charge. Okay, this is the one of the scenario we can charge the depreciation. Under that scenario, if we have the investment property, and that investment property we are recording at fair value. Okay, recording at fair value. Under fair value in accounting, there is a no depreciation. Under accounting, there is a no depreciation, right? So under accounting, if no depreciation, the city law is saying yes, you can charge 4% depreciation on that. So starting from this effective from 2025, right? So no depreciation. In 24 we already submitted the return. The letter on the ministerial decision is came, okay, the investment property or the proper property, you can take the depreciation and record in the return. In accounting we are saying no depreciation, because as per IFRS on the fair value we are not recording the depreciation, but tax saying city law saying you may charge the depreciation, right? Anyhow, we will come on this topic, we will see. I just give you the uh, one of the point. Anyhow, let's come. Hope I answered your question. Let's come back to the our current topic. Okay, so now would the taxable person elect for the realization basis? So this is the our choice. We are saying we are knows A and B, right? We knows with the A and B. This is the A. This is the B. So one of the election we have to take. So here is the capital, and here is the all. So this is, and now we understand the capital, and here we are seeing the revenue. Okay, revenue. What is the revenue item? Anybody? What is the revenue item? What is the revenue item? I appreciate your comments. Sorry. Okay. Revenue, like we discussed the inventory. One of the, if we are in the the where the trading item and the inventory is the one of the major item. Okay, it may have the huge impact. Many the companies, if you we might take the dairy item, milk item. Okay, milk item, the dairy farm. Okay, so what is their inventory? The milk is their item. So the who's distributing the milk. Okay, so this is, there is also the inventory. This farm have the milk is inventory, and this inventory and the fresh milk is maybe the validity or expiry is 5 days, 10 days, something like that. Okay, so just imagine if the stock available at the year end, and the auditor passed the the provision. Okay, and he adjusted the inventory. He adjusted the inventory is from the 100,000 to the 70,000. Why? Because this is the perishable goods, and the perishable goods may expire. Okay, may expire. If you made the 70,000, is major amount for considering the whole. I'm saying the 70,000, but this will be the more than that. Okay, and I'm just trying to quickly come on the example parts where we will understand with the example, because these things we already discussed. Okay, the election we already discussed. This is scenario. Here we are saying the irrevocable election that we understand very detailed. Okay, so we can choose either capital or the different. Okay, the unrealized gain and losses if election is made on that. Uh, So it, we are saying it's irrevocable. This point we already knows. If we already knows, if no election, the second important point, if we are not making any election by ourselves, means the system it will consider unrealization basis by default, because if we are not saying yes, so by default you are opting for unrealization basis. You are not, you're saying I didn't make election, but you, if you by default is on no. Okay, by default is no, so which means you already made the election, that is also irrevocable. We have this scenario where they said, okay, when we are discussing the client, okay, the last year return, who made your return, why you are coming to us this year in 25, why you not raised in. So because this is part of the assessment, what where they are standing currently. Okay, of course we have to understand where currently they are standing. So they're saying, okay, we made the return filing and we asked, okay, what is the realization election you made? They said we didn't opt any election. So they're saying we didn't opt any election. So why? Because they are not familiar, so they just move on next. Okay. The moving on next, by default you are on unrealization basis. So why we are asking? Because we cannot do anything in this regard now. So whatever the cash flow benefit, cash flow management, we cannot suggest. Even that industry, if the op realization basis is huge cash impact on that. And this is the optimization, we might say, within the regulation, how to apply the regulation. Okay, so now the second, if we said yes, election is made, so then we are discussed previously all asset and all liabilities, current asset, non-current asset, revenue item, stock, inventory, capital item. This we already knows, or we will see election be only capital item. So far, is any question, any point, any question, any point? I appreciate. Yes, the fair value change is also gonna impact impairment loss and gain, also gonna impact. Okay, Peruvian do not fall under this election. The Peruvian mean the I'll give you the example of the Peruvian. This is very common and the mostly people are asking this. Uh, the Peruvian is a Peruvian for doubtful that will fall over here or no? At the year end, we are making the Peruvian for the last month, let's say the year end, December. Normally, company paying the next month's salary. So December month's salary is not actually paid, is Peruvian. End of service, okay, is Peruvian. Peruvian for doubtful debt. So these are all the Peruvian. Whether due to this election, these Peruvian are gonna impact or no. On these Peruvian, we will take this impact of the realization or non-realization election or no. Anyone, please? Yes or no? Anyone, please unmute yourself or send the chat or either way. Yes, Abdullah, who will take the Peruvian? Amir. No effect.
Sir, actually, I did not understand your question. Can you repeat the question?
Abdullah, okay. Abdullah, see, what I'm saying, if we make this election, we are saying here the election is A and B, or even we are going one step back. Okay, what is this election? What the question is this: if we make this election on the realization basis, here or here, if we make the election either on realization basis or no realization basis, so any adjustment will be come under to these provision or no? Effect of this election, either we opt for no or yes, it will be gonna affect this provision. Amir is saying no effect. Yes, Abdullah. Now you understand the question. Anybody, anyone else? Anyone else? I appreciate we have with us Muhammad Ifam, and we have with us Prabhu. We have this. Yes. See, the Amr is right. He's saying these Perveen is not coming under realization basis or on realization basis. These Perveen are not coming under this election. Okay. So the inventory, if we make the provision because we may sold on the same book value or less than book value. Okay, that is the gain or loss coming due to change in market value, change in market value that normally we are seeing. Okay, so, but the salary is the normal course of provision as per accounting, as per accrual accounting. We are recording, okay, expense we incurred or we have to pay this expense, but we didn't pay. So this is not subject to the election. If we have salary provision, if we have end of service provision, there will be no effect. It will be carried on in the same way. Provision for doubtful debt, it will not come in this adjustment. Okay, so let's come to the next. Okay, the provision gain. So now another is the unrealized gain and losses, and versus transitional gain and losses. Okay, both are the different, they are not the same. Because why we are mentioning this, in different cases we seen the it's difficult or challenge to understand what is the unrealized gain and losses and transition. So they treat this one also as per the same. Transitional gain and losses is a different, we have different tax treatment. Do not mix both of them. Accounting model, fair value model, and revaluation model. Under accounting, we have how many model? Accounting model is equal to fair value model. We are doing the fair value model and revaluation model. Both are same. Yes, Amir. Accounting model. Under accounting, we have to model. It's like that. Accounting model means we have the treatment, two treatment. One is the fair value model, the treatment. I'm not sure if the which one word will be more easy. And second is we have the revaluation. Revaluation. Revaluation model. You understand what is the difference between the fair value and revaluation? If we opt for the fair value, so every year we have to do the every year we have to take the fair value and no depreciation. Okay, the revaluation model maybe we have the policy, company have the policy every 3 years or every 5 year we will revalue. So these are the two different treatment. Okay, the fair value, what is the market value? Anyhow, so what we are trying to say under accounting, there's a two model. One is this, one is this. Okay, so now market value, we are saying asset and liability on both sides. We this effect is coming. Why? On market value, why? Because asset also, if plus and minus, it may gain, it may loss. Liability also, it may gain or loss, because liability may reduce or may increase. Yes, Amir. Yes.
So revaluation model means we need to revalue the assets using a third party, or what is the model, sir?
Yes, of course, there is the independent valuer who are giving us the valuation. Not we, if we talk about the real estate. So there is a many in valuation companies in the market who are approved or certified by RERA, one of the the or the DLD, Dubai Land Department, or any other Emirates Land Department. They are doing the valuation based on the by considering that applicable standards. In accounting, they are also taking the, I think, their IFRS 13, or if I'm not wrong, you might search on Google. There is a and IFRS 13 for the valuation. Along with that, they have the local, the guidance from the DLE department, or the rates from the DLE department, the local land department. They are considering that guideline. So they're normally saying, if the, let's give you the example for rent in Dubai. Okay, the RERA is the regulatory body who's regulating the this rent. So they have the different zones. Okay, different areas. Okay, each area they have. Okay, this is the minimum rent of this area. This is the A, B, okay, C, D. So they are giving the guideline. Okay, this much rent you can charge. Let's say A area is saying the 50K. Here is saying the 60K. Here is saying the 30K. So here is saying the 40K. So these are the guideline based on the different area, different factors they given that. So that's what I'm saying. As per the applicable IFRS plus local regulation, that is the Dubai Land Department, they are giving the valuation. Same like the if the plant and machinery. Okay, so the industry expert from that, the specific plant, there will be certified valuer. Okay, if we are saying the employee benefits. Okay, so the employee benefit in mostly the countries who are running the end of service through the normally we heard about the pensions. Okay, the pension upon retirement we start getting the pension. So these are the registered scheme in different country, or regulated schemes in different country, where the employer will add let's say the 50%, and employee will add 50%. Okay, so if what is the value, so there will be independent valuer who is doing the valuation on that, because of course. So these are the I just try to explain that yes, there is a valuer from that particular asset or particular industry, and that is certified. Not everybody is doing themselves. Okay, so the here the gain, no city, again, unrealized gain. I'm just coming to the other exercise part. Yes, this is the we are reached to the exercise part. We have to let's do it. City competition here. What we are standing. Why we are saying this is the accounting, sales, cost, profit, whatever. So we reach profit before tax up to here. Then we start doing these adjustment, and the election is one of that. So of course we already have the accounting profit before interest and tax. So now whatever the as the outcome of this election, we have to say add or minus. Unrealized gain or loss may be recorded either in one of the following in the profit and loss and OCI. So now this is the another interesting part, or another technical part. Maybe the unrealized gain we have to see. Why? Because if we are doing in the, this is the PLN part. Okay, I'm just trying to explain the importance what we gonna see over here. So this is the profit and loss part. Okay, So the OCI is the another part. So we have to see what the effect we said as the outcome of the realized or unrealized gain. If is already recorded here, so then we have to minus or plus over here as the outcome of the realized or unrealized. But along with that, we have to see either we recorded in the profit and loss and the OCI. If it's recorded in the profit and loss, then we will do the effect. But that item, the gain is recorded over here. There is no effect. Let's dive into the example because again, I think it will not be easy to understand without the practical example. Okay, so now we are understanding the profit and loss. They have two parts: the statement of comprehensive income. So one is the profit and loss statement, and second is the other comprehensive income statement. Okay, and by the way, this is the shown in the city return separate section after this. And they are also asking the in return if something you recorded here or something you recorded here. Do the adjustment accordingly. Okay, so the next we are looking into that other comprehensive income below item recorded into the balance sheet as other reserve as capital revaluation under accounting below IFRS may impact. So now see the IFRS, the treatment of IFRS is also important. Is not only we have to see the what is the corporatex law is saying, because the okay corporatex law is saying in accounting treat as a statement of comprehensive income, but the treatment is recorded here, so then still no adjustment. We said unrealization basis, so whatever the gain is recorded in the profit and loss, no adjustment. Why? Because the gain is recorded here, and we are starting from the accounting profit. There is no effect exists. So whatever the adjustment you gonna see, first look into that is already adjusted in our accounting profit or no. So this is the okay. Revaluation gain IS 16, IS 38, IFRS 6. These are these are affecting the our valuation gain calculation and recording in the financial statement. Okay. The second is the equity investment equity investment through other comprehensive income or through profit and loss. If the profit loss, it will be here, but we have to look into the financial and accounting equity investment where we recorded. Here is the IFRS 9. Debt investment, we also again we have to see either is a fair value through OCI or fair value through profit and loss. I'm just giving you the example. I'm not explaining what is the standard, because if we start looking in dive into the standard, so that standalone I think a couple 4 5 session just to understand what the standard is saying. So what is we are learning here? Focus on the accounting treatment, because our plus or minus based on the city law may affect it, may uh, differ the treatment. This is the important point I'm highlighting. Is so this is the currently we seen they are saying okay whatever the standard is fine. Here we said the unrealized gain is unrealized gain is disallowed because we opt for the unrealization gain. So what they will do, they if they have the like 500, if they have the 100,000 gain and that is recorded in the OCI, they opt for the unrealized election and they opt for all also, all assets, election A. So what they will see, they say, okay, we have to exclude this gain because it's unsold, unrealized, unsold. So what they will do, they will come in accounting profit is 1 million minus this 100,000. Okay. So now we'll pay the tax on the 900,000 only. But actually this 100,000 is recorded over here. It's not added into this. It's added over here. Okay, now their understanding is correct. Unrealization, we opted for unrealized gain election, so we have to exclude all the unrealized gain. But they miss the part we are starting the computation from the accounting profit, not from the TCI, not from TCI. So if something is already not over here, then we will not do this adjustment also. We will not do this adjustment also is not because this 100,000 do not affected due to this 100,000. Hope I try to highlight the importance of this. Let's come on the next part. No election under cash basis. So this is the another no election under cash basis. Why? Because under cash basis, no balance sheet. Under cash basis, no balance sheet. Hope we are familiar. When we opt for the cash basis, everything go into the profit and loss. No balance sheet exists under cash basis accounting. Normally, we are doing accrual accounting in most of the industries, so that's why we are looking into the profit and loss and balance sheet. So all expenses and income recorded. Okay, either it will be income or either it will be expense. Whatever we are doing, there is only two kind of recording. Either it will go to the income or it will go into expense. No capital and revenue item over here. And the cash basis we can opt only if our revenue is equal to and less than 3 million. Cash basis we can opt only if our revenue is equal to or less than 3 million. Okay, whether election is made on realization basis. So first we have to say the accrual accounting. If we opted for this is also in the first return the option is coming. In previous batch we have the discussion and during the return filing stage we received the I received the call, sir, I'm trying to file the return but return is not opening, is closed, there is no figure option to add the figures. Okay, it was the strange what he's explaining. They think we already submitted the complaint to the FDA and everything we did, but FDA is also not responding. I said, FDA, you are expecting to help you to file the return. They give you the generic information, a general guideline. They will not come and let you know how to file the return. What happened actually? They offer the cash basis. And now they're saying, okay, parent figure we already added, the balance sheet is not opening. After the cash basis, they process next, and return is submitted. They think return is not opening, but because they are not familiar what to do, wrongly they submitted the return. Anyhow, come back to the topic. Accrual basis, normally we are following accrual basis, then the realization basis and non-realization basis election will be there. So No, it will be, as we understand, the permanent, irrevocable, whether the gain and losses. Now we have to see the gain and losses recorded, as we said, no. So which means by default is on unrealized basis recorded. Okay, so now if unrealized basis election is opted on all assets, so we have to see whether the gain and loss is recorded in profit and loss. See another highlight, if it's recorded here, do nothing. Do nothing. Okay. Do nothing from city adjustment point of view. City adjustment point of, if recorded in OCI, see, if recorded in OCI, adjustment is required. The same election, sometimes we are saying do adjustment, sometimes we are saying do nothing. Why? Because our accounting standard treatment, how we recorded in our books, based on that, this is changing the our activity. Recorded in OCI, adjustment is required. Okay. Gain, if the gain we have to plus, if the loss we have to minus. Okay, if the election is made, here we said no, now we are saying yes. So then the option is saying, okay, if you're gonna make for all or only capital, based on that again treatment our change. When gain and loss is recorded on capital, so we have to see it's recorded in profit and loss account. So maybe is the gain, it will be minus. If it's loss, we have to do plus. This is the adjustment we have to do. But if it's recorded in OCI, do nothing. See what here in profit and loss, we said do nothing. Here in OCI, we said do nothing. You understand up to here? Are you have any question, please? Okay, let's. We have this example. We are trying to take one practical example. Okay, if the building net book value let's take one example, one building, net book value is a 1 million. I hope you will have the calculator and the pen with you. Net book value is 1 million. This is the first point, net book value. The second is the life is 10 year. So now we have to see the depreciation. What we are doing, 1 million divided by 10. So 100,000 per year depreciation is recording. If we are recording the net book value is 1 million, life is 10, so we are dividing by 10, so 100 per year depreciation is coming. So let's assume we have made the realization basis election. So now the realization basis election is made. Important is that realization basis. Okay. So now the same building, uh, upward revaluation. Upward revaluation. But the main, we said this is the property. Here we said the net book value is 1 million. But what happened at 31st December? The market value, okay, the market value is 1.5 million. 1.5 million. If the market value is 1.5 million, so what is the gain? What is the gain? 500,000. So 500,000 is our gain. So unrealized gain, next step we have to see as per IFRS what we opted and applied. Gain is recorded where? In income statement and profit and loss. So which means, let's see, our accounting profit is, our accounting profit is, I'm saying the 200,000. Now this accounting profit already added over here, which means this 2000 is, how is coming? 1500 plus 500, which 500 is this. Okay, so we are seeing is already recorded here, and we opt for the realization basis. So what we're gonna do that, will minus, so how much it will be? What we understand, because this is already added over here. Now we minus, we reach to the original figure before, without this scheme. Less from the profit before tax. This is what we, now this is the year one. This is the year one. Now here another important concept or the important understanding. Let's see what we did, only this 500. Now depreciation, if the depreciation and the year one, okay, this we already did the minus. Now the depreciation also coming in the profit and loss, right? So depreciation also coming in the profit and loss, because the asset is now at the 1.5 million. What we did, 1.5 million divided by 10 years. So now the depreciation is increased 150. How much the depreciation over here? And how much is here? Here is a 100 and here is a 150. So how much is the increase in depreciation? Yes, Prabhu, 50 added back. Okay, so let's understand. So here the increase in the depreciation is a 50K. So now our net book value, we understand this is coming as 1.5 million depreciation. We recorded 150,000 as per the net book, the revalued amount. So now the asset is shown. Asset is shown the 1.350. Why? Because we already minus 150. Anyhow, this is the accounting depreciation. Now here you will understand, I'm giving you the wording for our understanding. Here the accounting depreciation and the tax depreciation will be different. Let's take as the example. Let's keep the understanding. Accounting depreciation and the tax depreciation will be different, just for understanding. Why? Prabhu, now I'm gonna mention over here accounting depreciation. Here I will write the tax depreciation. Actually, in text there is no depreciation under this concept, but the treatment is differ. So that's why I'm giving the name the accounting depreciation and the tax depreciation. In accounting, because our book value, net book value after revaluation 1.5 million divided by 10, so accounting depreciation in year 1 will be 150,000. Because we opted for the realization basis, we said add back this 500,000. Minus, remove from our calculation this 500,000. Okay. What does it mean? Will not pay tax in this year. So we excluded from our gain. So now in balance sheet, asset is the 1.5 million. The depreciation, accounting depreciation is 150. So now how much will be tax depreciation? So whatever the additional allowed if net book value is less than 1 million. Accounting depreciation 150 and here is 0. Tax depreciation is 0. Yes, Prabhu, you're saying add back 50, but now the tax depreciation we are saying is 0. So how much add back? Add back 150,000. 150,000. Why? Because we will start depreciating once the asset come on the original book value, on this original book value. So whatever the depreciation coming above on that original net book value, we will consider 0 tax depreciation. Whatever coming here, add back. Yes, Amir, you understand this point? Abdullah, Tez, Mohammad Ifam.
Sir, one doubt.
Yeah, please.
But we cannot book a depreciation based on the historical cost, 1 million.
See, this is what I'm saying, how you will record. Because in this is what tax law is also saying, because your original net book value before this revaluation is the 1 million and it's coming is the 100,000, right? But now your asset is already above the net book value. Above the net book value means you recorded as 1.5 million. Okay. So the law is saying until unless your asset exceeding the original net book value, no depreciation. From here, the 15 million, we are saying the 150, so net book value is 1.350. Okay, still above 1 million. So law is disallowing is saying no depreciation to be charged. Let's continue this example. You will understand this point. Yes, Prabhu, we are going towards the same point. We are, because our learning will be complete once we cover these steps. Okay, the first year we said, that's why here the year one. Now, what happened that year two? Again, the depreciation is 150. So here the asset value was 1,350,000. So again, year two depreciation 150. We minus. So what is the net book value? Carry forward 1.2 million. So again, is above 1 million. 100% disallowed. Disallowed means add back. So let's see the year three. Year three, we set the depreciation again 150, and the net book value was 1.2 million, and the after this depreciation, after this depreciation, asset value is still above 1 million. So this also disallowed. Let's see the year four. In the year four, net book value was 1,050,000 minus 150. So whatever the less than the 1 million, that we will keep it. That is allowed. Whatever the above 1 million will be disallowed. So here 50 is a disallowed. Here 50 is a disallowed and 100 is allowed. 50 is allowed. This is no, this is no, this is no, and this is no. So I try to explain with the practical calculation how it will be recorded. So I believe, Prabhu, now this point is clear, and you also was mentioning the same thing. Okay. So, but anyhow, we covered the practically. Okay. Now, this is again the depreciation, how much will be disallowed. Okay. But another point, just understand, the first is we covered up to here is now the what is the sorry, these disallowed depreciation, will be deferred tax asset. Year 1, 2, 3, whatever, 150, 150, 150, 50. It is a deferred tax asset. What is a deferred tax asset? In future, it may adjust, or we will adjust against the yes, please. Yes, Prabhu, please.
So, my question remains now in this, let's say in year two, I make a downward revaluation, and from let's say 1350.
Your voice, Prabhu, if you close your mic, it will be much easier to understand. Your voice is very low.
My voice is low.
Yeah. Just now try.
Can you hear me now?
Yeah, please.
No, my question is two. It is I do a revaluation, it comes to 950.
See, Prabhu, we are not able to understand because sometimes your voice is fine, but now it's not audible. But what I understand you're saying, another scenario, maybe in year one, that maybe you might say yes or no. In year one, we revalued from 1 million to 1.5 million. Now, Prabhu, maybe I think he's trying to say in year two, from 1.5 to it came back to the maybe the 900. Yeah. Okay. So this is what you are trying to say. Okay, see, at the each point, at the each point, okay. So then here we have to, we will actually, this part is coming in the next slide, but I'll just give you the short answer. See, this scenario, if this is the scenario and we are recording in our books, so we are treating in this way. It may be changed at this phase due to revaluation. It may change this, but let's understand, because if it's changed, so what is the our point over here? Just focus over here. Our learning is this. Our learning is this: whatever the value above 1 million will be disallowed. So we prepared the example just to understand how it will. But if you're saying if the value is changed, it came below 1 million, of course that will be allowed. Okay. Just to learn this, we just doing the example. Okay. But let's complete this example, this scenario. Hope I clarified your point.
Yeah, yeah.
Okay, thank you. Okay, come back to the. So now under this scenario, where we are having the gain, and we said this is the disallowed in the form of depreciation, because why we are saying this is disallowed? Because we said unrealized. This point again, I'm just let me try to cover why we are doing this. Why? Because this from 1 million to 1.5 million, we have the gain of and here we said realization basis. Okay, and this the change in value. This is the from 1 million to 1.5 million. How it came? This is the market value. Market value means revalued based on the market. We, but what is the our common understanding or common thinking? Let's see, is sold or unsold. It is sold or unsold. Just think from that point of view. Okay, unsold, no cash hit into the our bank. This is the just number. Okay, we didn't receive the cash. So versus here, cash hit into our bank. We actually receive the funds, actual funds received. If we receive the actual funds, so we have the cash to pay. What is the owner is thinking? He's saying, I have the cash. Okay, I can pay tax. No problem. But if you ask here, owner or the shareholder, pay a tax on which this 500,000. He's saying, okay, where is this 500,000? I did not receive any cash, and you are saying pay the tax on that. Just this is the just number in the books. He's saying, okay, even you made one adjustment or recording in the books, and you are saying they pay 9% on that. He don't want to pay. So how much the 9% on 500,000? Anybody can calculate 500,000 9% and just mention in the comment. So now we are saying to the investor pay 45,000 tax. Why? Because in balance sheet we just recorded one figure. In balance sheet we recorded 500,000 and pay the 45,000. You're saying you not give me any cash, and on addition that you are saying pay the 45,000. So I believe you understand the concept of the sold unsold and the realized unrealized, why we are doing this activity. Because if you do not have actual funds to you and somebody asks you give me the text, so it will not be understandable or easy for that. So this is the reason we are doing. So as long as tax authority said okay, this gain you are saying is unrealized, so accordingly we did not allow, you didn't pay the tax on this. When actually it will be sold, then I will pay. So in future the same asset may be sold at 1.6 million or may be sold at 1.4 million or less than 1 million. So anyhow, so here we are, our understanding, we are focusing that, what is our focus is that, so whatever disallowed depreciation, because this gain is not taxed now, in future it will be subject to tax. In future it will be taxed when? At the time of actual sale. So I think okay, fine, you can keep this depreciation as a deferred tax asset. When actually you sold, this gain will be at tax. At that time, this depreciation that is previously disallowed, now you can minus from here. Uh, Above all, disallowed depreciation to be recorded as a deferred tax asset due to different or different due to different due to difference, a different treatment in accounting and tax. Here we are saying the difference and different. Why? Because the difference is that here the depreciation in accounting is 150 and tax is saying is not allowed. Okay. So we might say that due to different treatment or due to the difference in the tax and the accounting wording or the the application. The important thing is temporary, means upon sale will be utilized or expense out against the gain. Let's say at year 5, let's say at the year 4, after the year 4, we can say the year 5. I'm assuming keeping the same asset is sold. Asset is sold. If asset is sold at 1.5 million, okay. So now what they're saying, first you have to, because this is a deferred tax asset, previously disallowed depreciation. So do one thing, minus 150 year 1, again they're saying minus 150 year 2. So all this will be minus first, then see what is the gain that you have, then calculate 9%. Right? So ultimate, we adjusted in the year of sale all the depreciation that was previously disallowed. Any question, please? Yes, Prabhu, Abdullah, Amir. Okay, so let's continue the our exercise. Why we have capital gain and losses arise upon sale of asset? Because due to under over depreciation. Okay, this is the currently we seen the over depreciation. We mentioned the if under depreciation over depreciation both will be adjusted. This particular example for over depreciation may more beneficial for future means upon sale of profit. So now the next question is the downward revaluation. Next question is downward revaluation. So now the Prabhu, the earlier he was asking one of the point. So let's assume net book value is 100 million, but the market value is 800. So we have the loss of 200. To be recorded as a deferred tax asset as a temporary difference upon sale of expense will be expense out against capital gain. So here we are 800,000. So 800,000, what is the our life is 10. So divided by 10. So depreciation coming 80,000. So this is 800,000 divided by 10 years. So now net book value is 800,000. Market after this depreciation 720,000. Are depreciation allowed? So now the example we've seen, as long as our learning is here, if asset value below the original net book value, all the depreciation is allowed. This is our learning over here. The second is this whatever the disallowed is deferred tax asset in the year of sale, it will be adjusted. So any point over here. So let's move to the next. Okay, so now the important understanding that we have to see, what is that overview of accounting, recognition, measurement of asset and liabilities. We know what is the law saying. So, but that is not enough. Now we learned what is corporate tax law is saying, but that is not enough. We have to understand what is the actually treatment happen in the our books of accounts. Okay, the basis of preparing accounts. We have to understand what is the basis of preparing accounts. Accrual basis are the cash basis. We seen in the previous example, if the cash basis no balance sheet, so there is a there is a no option that current topic we are discussing. So this election, what we're discussing, is irrelevant by default. Everything is on a cash basis. Okay, now the taxable income. So the second point, taxable income, accounting profit before tax, add less unrealized gain losses if realization basis is opted. Then next is accounting asset and liability recognition and measurement under IFRS. If IFRS have different treatment, accordingly we have to look into that point of view. Normally, we are familiar property, plant, and equipment. So these are the three different classes as per IFRS. Three different classes. Asset like property is one, plant is two, equipment is three. 1, 2, 3. So these are is coming under IS 16. Okay, but PPE, property, plant, equipment, these are three different classes of asset, and treatment or the accounting or the adjustment may differ. Okay, so now we have to see the historical cost model. Historical cost, less accumulated depreciation, less, see, it's not only the depreciation, here is the impairment also. Historical cost model, what we are doing, accumulated depreciation and impairment losses. If we minus this, then we are coming to the net book value. Reliable model means mostly is using, mostly is common in the market also, and the MR properties. If you go online and search the MR properties, you can find the financial statement of the MR properties. Why? Because this is the public listed entity. That's why their shares are traded in this stock exchange. That's why their financial are available for the public. So they keep keeping their financial on the keeping their financial accounting recording on the cost model, historical model. Okay, the first point, basis of the accounting. Second, the taxable income, where the effect is there. Next is the accounting asset and liabilities, where we have recorded as per IFRS. Next, the historical cost model. And sixth is fair value model. Whatever these are the points we have to focus on that. Now, the fair value, then we have to see the fair value through profit and loss or fair value through OCI. Okay, so the fair value through profit and loss recorded at fair value at each year end. Increase in fair value, income into the profit and loss. Record at fair value at each year end. Now, important every year. Increase in value, increase in income account. Decrease in fair value, expense in the income statement. Okay, income also adding into the profit and loss, expense also hitting in the P&L account. Under fair value model, no depreciation. Under fair value, normally no impairment. Now, I believe now you will understand why we are addressing these points, because these points, if we overlook, our return filing or the return competition will be compromised. Of course, all this, when you look into your audited financial statement, it will be addressed. But now the another dilemma is there. The audited financial statement is also maybe not prepared professionally, because tax law is saying as per IFRS, and they now, if the audited financial statement not done professionally, because they did not apply correct IFRS compliance, as this is the current dilemma of the market. The people who's issuing the audit reports, they may be not familiar of the what we are talking about, what we are talking about, what we are talking about. If such treatment is not done appropriately and disclosure is not there, so error in the return filing will be higher. And this is not the mistake of the tax accountant or the consultant or the agent. This is not the mistake of them. This mistake happen as the outcome of the inappropriate inappropriate audited financial statement. Okay. Next, used in a different IFRS financial statement, financial asset, biological asset, investment property. Okay, that's we already seen the different IFRS used. Okay, so next is the if recorded in fair value through other comprehensive income. Of course, the treatment is different. We seen in the previous slide the how what will be different. Recorded in each year end, increase in fair value, increase in OCI, decrease in fair in OCI, no depreciation under fair value. So if this is already on what we saying realization basis, so we have to see if recorded over here, so what are the adjustment we needed or we don't need it. We seen in the previous example, if in OCI, okay, is not already added over there, we will not minus. Use in different IFRS financial asset and H accounting. Revaluation method. Next, we have the point number 9, revaluation model. So now here we are saying the fair value and the revaluation model is not equal. What we are trying, we've seen in previous many points. So these both are not same. Revaluation, fair value and revaluation are not same. Why? Because they have different treatment as per the IFRS. Of course, it's affecting the our return also. Of course, it will be affecting our return competition also based on due to different treatment. Timing of revaluation, organization policy may be every year or after 2 years and so on. Revaluation gain goes on to OCI. Revaluation gain and losses will go to profit and loss. Depreciation charge, impairment losses arise. These are the 4 or 5 points. Based on there, the treatment is getting different. Why? Revaluation method may take the see. Here we are saying it may go to the PLN, it may go to the OCI. So the fair value we are saying every year. Here we are saying after 2 years, after 3 years, the treatment is may change. Okay. So here we are saying the revaluation gain, fair value. What is it saying? The fair value, the revaluation, very important. Under the revaluation method, revaluation gain going to OCI, but the revaluation loss is going to profit and loss. The gain we are recording in the other comprehensive income, but when loss is coming, we are recording in the profit and loss. The next difference is depreciation is already charged over here. Impairment loss is also charged over here. So just look into that. No depreciation, no impairment. No depreciation, no impairment. Here is if it's coming from through profit and loss, all treatment will be recorded over here. Gain and loss will be recorded over here. If we are opting for the OCI, everything will be here. We're not discussing the IFRS, but we are discussing IFRS treatment. The outcome of the tax return will be different. Okay, so let's move to the slide. Any questions so far? Okay, gain and losses under IFRS, taxpayer can elect to record gain and losses either on realization basis. Election is required. Reason no, but Earlier, we just discussed the same point. Realization basis election is made because no money to pay the tax. And then the second financial statement must be prepared on accounting accrual basis. And this is a realization basis election. We said irrevocable election for capital asset and liability are the all assets. The same we are discussed realization basis, unrealization basis, the same point. I believe you already understand this concept, but again, we are adding in a different way to explain in okay. Unrealized basis is automatic capital account or taxable gain revenue account foreign currency. Here the another is foreign currency retranslation. Okay, this is one of the revenue accounts. Anything else? This is the another. For financial institution, only election P is available. What is the financial institution? Banks. We already discussed. That's why they are not giving the A and B because by default only for them is B. What is the B? Capital. For insurance and so now Abdullah, your question will come. Okay, all the industries or all the businesses, the both election will be applicable. All the business they will have the all asset, all liabilities. No, the banks and the insurance they have only election B capital. The all is not available to these two industries. Anyhow, let's jump to the next. Accounting gain and losses, taxpayer can utilization basis record on disposal of asset or settlement of liabilities. This we already learned this point. Gain and losses on disposal of asset or settlement of liabilities. That is the actual. Here the word is realized when actually the event is happened. Simple example: fair value model, land or investment under investment property. So let's take the fair value. ABC company profit before tax is a 500,000 and gain and losses on realization basis. This election is opted. This election is elected. The cost of asset on the 1st July 2024 is 100,000. The first tax period is December 24. In July, the cost of purchase of asset was 100, but in the year end, it was 100. At the year end, it now is come up to 120,000. So, which means 20,000 is gain, right? Asset at 31st December 120,000 and 20,000 gain recorded in profit and loss, and this gain is recorded in the profit and loss, and the election is the realization basis. So what is the treatment now? Yes, I'll appreciate the other participant also, the Muhammad Iflam, Artes, another Muhammad. So please let me know what is the adjustment that we're gonna make. Hope you understand the question. So let me know what is the adjustment we will make. So here, because we opt for the realization basis in accounting profit, in accounting profit accounting profit, this 20,000 is already added. Let's take the example if 200,000, if the accounting profit, so in which 180,000 plus 20,000. This 20,000, this 20,000. This is same 20,000 is already added. But when we opted the election elected, so now this 20,000 we have to minus. We're saying we will not pay tax on this 20,000. So balance will be 180,000. So adjustment will be deduct this 20,000, reduce this 20,000 from the accounting profit. Let's see, this is the election made to record gain and losses on utilization basis. Remove any gain from profit before tax. Only those recorded in the profit and loss. Is saying if we recorded in the PL and not in OCA. So here we said remove 20,000 figure is not realized. Keep 20,000 under capital account and accumulate with the future year change in value. Okay. So now they're saying this 20,000 that we minus, so we are saying, see, now this will be not recorded, but still we have to keep the separate books where we have to maintain this record. Okay, keep AD under capital account and accumulate with the future year change in value. Okay, so we still have to keep the record for these whatever they disallowed. In future, when the asset will be sold, so we have to minus all this disallowed in that year, whatever the previously disallowed. Unrealized gain and losses will become taxable or crystallized or realized on the disposal of asset in the period of disposal. So if whatever the gain is a taxable over here, it will be taxable in this year. Okay, so whatever the gain is a taxable, so we have to in the year of sale. Okay, keep record of unrealized gain and losses for future reference. Upon sold will be settled. So now the next, the same example. Let's see. See, this is a scenario now. Taxpayer can elect to gain and losses on utilization basis election. Let's see what is the example of this. No, this is the same example. Yeah, this is the same. No, this is the revaluation model. What is there? See, fair value model. Okay. So now let's go to the next fair value model. Here we have to add the fair value. So the fair value, now the accounting profit before tax, we are saying the 500,000. Okay. Accounting profit before tax, how much? 500,000. Gain and losses on elected. Realization basis elected. Okay. So now asset is 100. First tax period, December is the reporting. Market value in December is 120. Gain, revaluation gain or 20 recorded in the OCI under the revaluation model. So what will be the adjustment? Here we have to make the adjustment. So please let me know what is the adjustment. Abdullah. Amir. See, if you do parallel with me these examples, so it will be understanding to you. If I'm keep doing, so it will not give you the much clarity as you should do with your hand. So now onward, we will keep doing such activity. So please let me know what will be the adjustment in this regard. Hurry up, we have to cover the couple of more slides with the examples, different scenarios. Abdullah, everybody, you say whatever coming in your understanding is not always about right and wrong, but respond, please. I'm just looking to the YouTube if comment is here. No depreciation. Okay. Okay, so Amir is saying no adjustment, Prabhu is saying no adjustment, Abdullah saying reduced by 20,000. Amir, you mentioned saying no adjustment. Will you let us know why you are saying, and Prabhu, why you are saying no adjustment? Because the word is very important, what we already mentioned over here. OCI. The word OCI is the yes, is coming below the it's not coming accounting profit. It's coming because here we are saying accounting profit before tax. So this is not here. So this 500 will remain 500. So this 20,000 not came over here. Election made to the record and gain and loss normalization basis. Remove any. So what is our learning? Remove any gain and loss from the profit before tax figure, only those recorded in the profit and loss. What? Who are recorded in profit and not on OCI. This 20,000 is recorded in OCI. So what is the law is saying? What is our learning is here? We will remove only those gain and losses who already added in the profit and loss. If not added in profit and loss, then why to adjust? Abdullah is saying why you miss the whole idea. Then if you're saying the why at this stage, this in the beginning we discussed. Okay, as per the accounting treatment, realized or unrealized. If we are opting the election, if we're making the election realization basis, so whatever the unrealized gain, we have to exclude. This is our topic, realized. So if the above profit, if we did not add any unrealized profit, so then we will not make any adjustment. So this is our learning. If any gain or loss recorded due to this election or due to revaluation or the fair value into the profit and loss, then we have to do this adjustment. If it's already under the OCI, which means the accounting profit is not affected. Why? Because tax computation is started from tax computation starting point is accounting profit, not the other comprehensive income. That's why we are doing plus or minus. Hope of the law you got this point.
But sir, it's written here we have elected.
Yeah.
Like sir, it's written here we have elected. In the example, it's written elected.
Yeah, elected. What we elected? Yes, it's written elected. What we elected? Which election we opted?
So sir, we have elected either realized realization basis or not.
Yeah, now you tell me, na. So we elected realization basis or no? Under this example, which we are discussing, so which election we elected?
I understood, sir. Now, sorry, I was confusing at one point.
See, realization basis is required. This is the election we are discussing. The whole concept from today we are having. So if see if you may distract from this session, so whole concept will be out of your control. So today we are discussing only one topic that we discussed in the previous, the part maybe 20 minute, 15 minute. So now from last 2 hours we are discussing the same topic. But in more detail, we dive into that and we're trying to understand what are the possible scenarios where the different treatment may happen. Right? So from last 2 hours, we just spending on this topic with the different scenarios. Anyhow. So this is the understanding we learned over here. As we started our city competition calculation before tax, so we need to adjust anti-valuation 20,000 recorded in the no. So we no need. Okay, the no is important. No adjustment in this regard. But still is saying keep this 20,000 in capital account and accumulate with the future years. Means we have a document. In the year of the sale, it will be crystallized, means taxable. Then we will adjust over there. Transitional 61 transitional. Okay, so now we already 9:30. So if we start this topic, so it will take another 1 hour. So let's park over here. So let's park over here. So we are, I think today is the session 9, if anybody. And May 21, we are closing over here. 2026. So any questions? So most welcome. So because I may continue, but tomorrow you also have the office. Stop recording.
Recording stopped.
Yes, any question, please, quickly. Any question? I appreciate all the participants if you subscribe the YouTube channel and share your feedback or share your comments over there. And if you have any questions, so please let me know. Please let me know. Where is this chat? Thank you very much, all the participants. We have the Abdullah with us. We have the Amir. We have Muhammad Ifam. Then Muhammad Tez. Okay. Thank you very much. Have a nice day. We'll continue the transitional calculation, transitional, how it gonna affect in the coming Sunday. So I appreciate. Keep with you the calculator, notebook, pen, and be active. Be active. Okay. So there's okay, regarding the slides, so we'll think about that. We'll do something. I'll try to do in this regard. But we'll try to see only the participants who are active with us. So let's see. We'll come back. But normally we are not sharing this slide. Why we are not sharing this slide? I'll just explain you all that perspective also. Because if the person is already attentive, he have all the recording. If you have to make your own notes, your own slide, because even you have the many books, if you're not spending the time, you cannot understand that. So if the same video you on at the YouTube recording and start making your own notes, because how you understand, you will be right much better in that way. Here, how I want to share with you, I just prepared in that way. But I think you can make your own notes and keep adding on that notes. So this will be your understanding. So anyhow, we'll come back on that. So any other questions? So any other question, please? Thank you, all of you. Have a nice day. Thank you, everyone. Have a nice day. So we are leaving over here today's session. We'll come back on the coming Sunday, 11 a.m.